Welcome everyone to the Take on the Market for December 8th, 2017. My name is Andrew Rocco. I'm an education coach with the MarketSmith team. I'll be your host today. Just please take a second to read our disclosure here and we'll be jumping into things. Okay, as always, we're going to get started with the current market and our market arrows here. So I'm keeping the three arrows intact to the upside. I know that these last few weeks haven't been easy. The market indexes, one thing I'm noticing is volatility has picked up, meaning the price swings have become a little bit wider and looser. We'll be talking about that. Leading stocks, they haven't really fallen apart, although volatility has picked up in those, and there's also been a lot of pullbacks, but not too many are really broken at this point in time. And our portfolio on the year remains up. I completely understand if you're questioning this last one. Over the last few weeks, my account has pulled back in. I know some of my colleagues has. So there has been some rotation and it has been a difficult few weeks, but I'm going to keep these three intact because not too much has changed as far as the big picture is concerned. Taking a look at the NASDAQ composite, what I mean by this is this continues to trend above the 50-day moving average. You could see some wide price swings in here. So definitely have been stopped out of a few positions. There's been some volatility, but all in all, the uptrend continues. Here's a look at the IWM, which tracks the small cap index, the Russell 2000. You can see had a nice run, formed a base, broke out of that base and pulled back to that base. Now, what was resistance has become support. So this is a theme I'm seeing. A lot of indexes and stocks are breaking out of bases and retesting the tops of those bases. So that's completely normal action. We'll get a little bit more into that later. Let's get into the top performing industry groups. So like I said, a lot of rotation occurring. It was semiconductors were the leaders, computer software, which are none of those two groups are really broken, but they definitely have pulled back in recent weeks. But what's really surprising is retail, which has been a terrible industry group at the lows. A lot of these retail stocks are creeping back into the top industry group. So I don't know what the reasoning is, if the sellers just dried up or what's going on, but we always want to trust the price and volume action. Price and volume action trumps all of our opinions about particular industry groups and stocks. And right now we're seeing some of those retail stocks move up, some steel stocks moving up, finance, banking, brokerages. So just pay attention to this. We don't want to just run out and buy them because they moved up, but there are some industry groups showing strength aside from what's been the last year, which has pretty much been the leading tech growth stocks. So pay attention to that group rotation as always. Here's a chart that we've gone over countless times. This is the SMH, which tracks the semiconductors. You can see back here, broke out of a cup with handle looking base, had a really, really nice run. Now it's kind of having normal pullback. Now, right now it's beneath the 50-day, so a lot of these stocks might have been stopped out of. We want to continue to monitor this. Remember, the 50-day is a good area of support to pay attention to, and we want to see an index, a stock, an ETF hold that 50-day moving average, but it's not an exact point. So we want to see this get support in this area, come back through that 50-day, or it might need to form a base. Nonetheless, we want to continue to keep these on the radar. Here's an interesting one. This is the Computer Software Enterprise Group. I mentioned this breaking out of this base here. Now, what's interesting about this, you can see it had a big shakeout. This is a weekly chart. It had a big shakeout, and where did that shakeout stop? It got support at the top of that base. So when you're looking at these shakeouts, these pullbacks, look for them to get support at the top of a previous base. That's completely normal action. And it actually finished this week right above that 10-week moving average. So it still has work to do, but a really nice reversal. A lot of these computer software stocks found support this week. Moving forward, like I mentioned in the beginning of today's webinar, action has become a little bit more volatile. The price swings have become a little bit more violent. So in my opinion, the best way to combat volatility is smaller position sizes and wider risk. The smaller position sizing is going to allow you to sit through these wider swings. And just because there's volatility, we don't want to get out of the market. We still want to be taking advantage of this bull trend. But the smaller position sizing is really going to help our emotions. If we have too big of position sizing, our emotions are going to tend to get the best of us. And again, widen that risk if at all possible. Never more than 7 to 8%. But just keep that in mind. That's something that I found over the years that helps with a more volatile environment like this. Rotation has become more apparent in recent weeks. Like I said, in the beginning of the year, it seemed to only be tech growth names. Now there's a lot of other industry groups stepping to the forefront. So pay attention to that, to your industry groups, and don't be too concentrated in one sector or one industry group. If you were too concentrated in tech these last few weeks, you probably took a pretty big dent to your portfolio. So we want to make sure that we like concentrated positions and we like concentration, but to a certain extent. Pay attention to your turnover. Low turnover is optimal. So I know in a volatile environment, it's easy to get caught up trading a lot, stopping yourself out a lot. Lower turnover, for me at least, has been more optimal. So just really slow things down. Ask yourself, is the chart truly broken? Is it above the 10-week moving average? Is it getting support? Where is it in relation to that previous base? I have this next bullet point in boldface: do post analysis. If there's one thing you take away from this webinar, it's do your post analysis. That is the best teacher. It might be painful for some of us. I know I've made a lot of mistakes this year, and every year you're going to make mistakes, but there's no better way to learn. You know, you could read all the books, you could watch all the videos, all the webinars you want, but one of the best ways to learn is to do your post analysis. And I'm going to talk more about that in a second. And like I said before, lots of stocks pulling into the top of previous bases, which is completely normal action. I'll show you one example of that. So these are some bullet points regarding your post analysis. So here's a few questions to ask yourself. You can come up with your own, but these are some basic ones that will get you started. You want to answer this for the entire year of 2017. So what was my average holding period in these stocks? Typically, what we found in-house here is longer holding periods are more optimal. So we want to we don't want to be in and out. We don't want to, just buy something because it's pushing up on the 5-minute chart. We want to just step back and take advantage of the trend. Which setup has been most successful? Are you most successful trading double bottoms, cup with handles, pullbacks? Find out what works for you. For different traders, they're going to be more comfortable trading different things. And it might surprise you which setup works best for you. So really drill down on that. What occurred after I sold the stocks? Are you prematurely selling stocks? Are you being too defensive in your selling? Find out, use the change date feature in MarketSmith and see what occurred after you sold the stock. Take a look at your position sizing, analyze that in relation to your trade and see if that had any effect on your motions. Ask yourself, am I truly buying those Ken Slim quality growth names, those liquid growth stocks with massive earnings, massive sales, high relative strength, breaking out of quality bases on massive volume? Ask yourself, are you truly buying those? And lastly, what is my batting average? Are you batting 20% or 30%? A low batting average is not terrible if your winners are outsized compared to your losers. So it's not the end of the world if you have a 30% batting average, so long as you're really riding those winners. But analyze that and see where you can do better. And here's an example of, like I've been saying, a lot of stocks right now, it seems, like they're really pulling back, but a lot of stocks are breaking out of bases and then pulling back into the top of a previous base. So like I said before, that what was previously resistance is now becoming support. And I drew two arrows. One is to the 50-day moving average in this case. The other one is to the top of that base. This is one of my favorite areas to trade against, and also one of the best risk reward. It's what's called a confluence area. It's when you have multiple things lining up at once. You have the top of that base, you have the 50-day moving average. In this case, you even have that daily kind of reversal bar to trade against. So that's what's known as a confluence area. That's one of my go-to setups. It's really, for me, it's been good risk reward. So thank you guys for tuning in. As always, if you have questions or comments, feel free to reach out to us. Our phone number here is 800-424-9033. Also, feel free to shoot us an email at reachus@marketsmith.com. Thank you guys for tuning in, and have a great weekend.